You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by Quickstrike, options pricing and analysis software. Quickstrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quickstrike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quickstrike is the perfect addition to your trading toolkit. Learn more about Quickstrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at Quickstrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time once again for TWIFO, This Week in Futures Options. The program here on the old Options Insider Radio Network, where we break down pretty much what the name says, this week's hot action in the world of futures options. Maybe some E-minis, maybe some gold, maybe some crude, maybe some lean hogs. You never know what's going to be on our docket because it's whatever was hot this week. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-scintillating Options Insider Radio Network, the font from which all of this info and all these great shows flow. Head on over there if you haven't been there in a while. Check it out. Click the tires. Click those fires over there. Break some breaking news from the world of options, trade analysis, unusual activity, all sorts of cool stuff. You can find it all over there, including all of the programs we do, all 15 of them, including many great archive episodes of this fine program. So you want to go back and say, hey, what was going on during Brexit or the election or maybe the more recent British vote or whatever the heck date and time and agenda you have to check it out. It's over there in our archives. You can find them there, as well as, of course, your iTunes and your TuneIns and your Stitchers and your so-ons and your so-forths. Also available via our app, available for iOS, Android, and the beloved Fire OS. And for the hardcore of you out there, you can also join us every Friday, 1:30 p.m. Central via Mixlr, Mixlr. If you tune in for Vol Views, just stay in there. We play some new shows in between. You can hop right into Twifo right after, so you can get our breakdown on all things volatility, skew across a broad spectrum of products. Again, whatever's lighting it up that week is what we will be hitting on. And joining me on the old program this week, my volatility compatriot, my futures options partner in crime, Mr. Nick Howard, the founder and CEO of Bantix Technologies and the creator of a little platform we like to use around here quite a bit called QuickStrike. Mr. Nick, welcome back to Twifo, sir.
Hey, Mark. Good to be back in the saddle here in my office and ready to go.
You sound just dripping with enthusiasm, sir. I can feel it coming across.
It's on the inside. It's on the inside.
On the inside. There you go. We need to get you in the studio.
Smiling on the inside.
Get you in the studio, prime you with a few beverages, and then you'll be ready to go for show time. Of course, speaking of the show is also brought to you by our friends over there at CME Group. And check it out if you haven't done so already. Head on over cmegroup.com/Twifo, TWIFO. That is, of course, where you can find the same reports that Nick and I use throughout the show. So if you want to follow along after the fact, you can certainly do that. Those reports are live there for you. Nick and his team do a little extra added wrinkle for you guys, though, if you can join us live on Friday. I think those links stay live throughout the week as well, which is you can actually do what Nick and I do during the show. We find something interesting, we find an unusual trade or something like that, and we click on it, and we get a little more info, what was going on, what day it went up, how it changed the OI, et cetera, and so on and so forth. For the Quickskew and everything else, all those links are also clickable. And right now, for you guys who are listening live, you can do that too. So check it out if you haven't done so already. It's a cool little extra. They didn't have to do that for you guys, but they did it for you. Usually it's only for the premium people who pay for the Quick Strike. But you guys get it for free when you listen in live to the show. So a little extra wrinkle. So if you find yourself with some time on a Friday, 1:30 p.m. Central, 2:30 p.m. Eastern, and you want to listen to a little bit of Futures Options talk, join us live over there in Mixlr, and you can play along with the reports. Of course, they work after the fact too, but you can't do that live clicking into the links for more info. Well done, Nick. Good stuff there. Since we're talking CME, let's hit it right off the bat, too. They had a big week this week. It was a big week for most of the markets this week with a lot of stuff popping off. We had the Fed. We had more will they, won't they dance from the Fed and from the Trump investigation. So a lot of things were driving the market this week. Of course, interesting almost disassociation sell-off going on in NASDAQ as well, sparking a little bit of concern out there. All that combining for Wednesday being a big day for the CME team over there. They hit a new record OI, 129 million contracts across their products, Nick, which is pretty impressive. Also, their highest volume day so far this year, nearly 30 million contracts, 29.8 to be precise. That came on Wednesday, so a lot of that, of course, was in the rates and the S&Ps as a result of the Fed move and things. But still interesting stuff. Any thoughts on those numbers, Nick, before we dive into our first product of the week?
No, like we always say, it's always good to see the open interest and the volume continuing to increase. As we've been mentioning lately, as long as we continue to have these little event volatilities, I think you're going to see that kind of stuff happening. And, what's interesting, I was keeping an eye on it this week. The weeklies as an example, the weeklies in the crude continued to trade quite a bit this week, even after last week's expected time to trade, right? When we had the weekly expiring when it was supposed to, or right after a meeting, and then they continue to go on with some volume. So, I think that even though we don't see a lot of volatility right now, the fact that OI and volume are continuing to increase is always a good sign. And we'll talk more about volatility levels and stuff like that as we go along.
Let's do it. Let's get into the volatility levels. We're going to kick things off in an area we don't always explore here on the show, Nick. But some interesting stuff has been afoot out there, so we thought it was a good time to check in on the E-minis. We actually asked you guys before the show started, what's catching your eye out there? What are you guys interested in? We gave you a few choices. We gave you the E-mini, the S&P 500, particularly not the whole E-mini product suite, crude, gold, or FX. And so far in the early voting, E-mini got about 50% of the votes here. So E-mini clearly on your guys' mind as well. So we thought we'd start there, Mr. Nick. There's been some interesting stuff we've been talking about it on another program earlier as well, Vol Views, that the skew in general seems to be creeping up a little bit out there, up about 10 points from that skew index over the past couple of weeks. So this is a good show to really dig into what is causing that, because of course we have the Quickskew, which can tell us, what is it, the call wing, is it the put wing, is it kind of all of the above? Of course, you saw the S&P E-minis off about 5 handles on the week net, so some interesting stuff out there. Before we even get to the skew, Nick, there's something that kind of just jumped off the page at me, probably at you as well. By the way, listeners, if you're playing along, looking at the report at the E-minis, make sure you go into the expirations tab and you enable the Wednesdays and the weeklies and everything else in there, because that's really so much of the picture. If you don't get the weeklies in there, you're going to miss a lot of the story, like what we're looking at here, which are these the big trade, number one with a bullet this week, and maybe potentially one of our crazier trades of the week too. We'll have to see if we get some others that usurp it throughout the show. We saw about S&P hovering right around 24 and a quarter right now to end the week there. And yet the number one trade wasn't something in, front month 2,400, something like that. Nope. It was 6 days to go on this 2075 put. Yes, you heard me right. 2,075 put. This was the number one trade with a bullet out here this week. 32,000 contracts of these bad boys lighting it up, including a massive print, 29,200 of these going up on Wednesday alone, as well as 3,000 and change going up today. So a little bit of a trickle today, but 29,000 and change going up through earlier this week. And one mega print over there, mega block on Monday. That's an interesting one. These are not long-term contracts, and this is opening papers. These contracts have 6 days to go on this. So our friend here is not exactly betting on. He's betting or hedging against, perhaps more accurately. We'll have Nick will get into a little bit. He has a chance to dig into this block a little bit more. If he was indeed buying these, then he looks like very concerned that something may indeed be amiss in the S&P. Massive sell-off over the next couple of weeks. This actually correlates with what we were seeing on the last show, Nick, where we saw some crazy upside buying in the weekly in terms of volatility products. So people buying, near-term, very aggressive upside in the volatility products as well. So maybe there's a bit of a correlation. Maybe our friend here is playing both. Obviously, if you want the volatility to spike, you need an aggressive sell-off. So maybe he's playing both sides of the fence here, or it could just be extremely unrelated but very coincidental paper. Either way, that was a weird one. That wasn't enough, Nick, to really kind of make you say, and scratch your head. Number two, also very active out there, were the even money 2,000 strike puts out there in the S&P, doing mega business today, shall we say. 28,750 printing today, 200 and change on Monday, a total of over 29,000 of these bad boys going up this week. That one's a little bit different, though. Most of the OI seems like it's closing on that one. So someone perhaps giving up the ghost on these, saying, you know what, maybe I'll keep my powder dry for another day, or perhaps they had some shorts there that were closing out. Either way, it looks pretty aggressive for them as well. Interesting stuff out there, pretty much across the board. Those contracts have about 7 days to go. They expire on the 23rd of these 2,000 puts. So a lot of weird prints going up out here this week. And of course, if you're on the upside side of the fence, you were not ignored as well. Let's say the extreme upside, not quite as active, but there were some interesting prints, including farther off all the way out there in DESA this year. So end of the year, we saw the 2,800 calls lighting it up to the tune of about 2,600 going up this week. Pretty much all that opening. So someone opening and establishing on the 2,800 level, could be a covered call, could be someone saying, you know what, we got some room to run here on the upside. So couple of interesting narratives unfolding out here in the S&P. Nick, I'd be curious to get your thoughts on those big blocks first, and then if you have some ideas onto what's going on with the skew, what's going on with the quick skew out here in the E-mini, I'd be happy to hear that as well, sir. Have at it.
Well, that 2075 put, it's kind of an oddball, right? That traded with about 7 days to go, so that was on Wednesday that we saw that happen. And just looking at the price right now, obviously it's got a couple days of decay in it. Right now the price is 2 ticks or about $1 on that contract at this point. So you got to figure it was somewhere around $1 or between $1 and $2 given where the futures were all day on Wednesday, and the fact that we don't see much of a difference in the volatility. So we are probably seeing, well, it depends what the K was. So you got to figure let's go between $1 and $3. And the only thing, like, we don't know if that paper came in and bought those or sold those, but the one interesting thing we can see from that contract, that's the E3CM7. Okay, that's the new Wednesday weeklies that are out there. So that expires on the first day of summer or next Wednesday. That's really the only place where we saw a significant change in the Quickskew. So, and again, because we're short dated on that contract, it's, we talk about skew being a tough one to call there, just because there's so few days to expiration. But that one came in quite a bit in comparison to everything else that's similar to it in terms of expiration. So I'm not sure. That's like a 15% change in the index that strike represents. And like you said, it is opening. So maybe it's a hedge, like you said, maybe it's a counterparty to the VIX call buying. Maybe it's somebody who had their book looked at and said, you better hedge on the downside for us. But it's kind of interesting. So I'm not really sure, since I don't get much outside color on that. I'm not really sure what we're looking at from whether that's a long or a short. But I know you mentioned that the skew index was up, and I'd like to get your thoughts on that, like what the measurements are and what do you think they do to create that index. But as far as looking at the Quickskew, we see the puts getting a little bit cheaper in comparison to the money, and we see the calls kind of hanging steady, maybe coming back a little bit, maybe not. But the other thing to keep in mind, though, our Quickskew numbers are percent rich or cheap to the money, right? But when you look at the percentage of the actual volatilities, even a 20% is not that much. 20% difference between the put and the money is not that much when you start talking about 6.5%, 7% volatility. So there is some skew there, obviously, in the curve, but the volatilities are so low. Those percents are small numbers then. So we still see the similar shaped curve, but it's an interesting place right now with these volatility levels. And if I take a quick look, and let me see if I can see what the 30-day volatility looks like here on the E-mini. If I come out here and I'll look at 2 years worth of this, see what they say. Yeah, so we are pretty much near, not at our lows, but near our lows in terms of the 30-day historical volatility on the E-minis. I'm going to go back. I'll go out even further. I'll go out 5 years and see how we stand there as well. So right now, volatility is low. So this is interesting. You get, and it could be that 2075 is somebody coming in there and hedging on a very easy, cheap price. But the thing that strikes me as funny there is that it's just 5 days to expiration mark. So I don't know. That's not really much of a cover, and it's not like it's the end of the quarter on the date or anything like that. So it just seems like a weird one to me. So I would say I'd vote for that one from a crazy trade of the day standpoint. But as far as overall skew, puts are a little cheaper, but not much. Calls are about the same, and vol is really low, and 30-day vol is at or around the 5-year low. So interesting things here. I would say, and again, not knowing this market all that well, but volatility is low, which means the puts in general are going to be cheap. The market has been rallying, or the market wants to rally, or people want to keep rallying the market. But a decent trade there would be hedged puts, not selling, but buying, because if there happens to be a break, then you're really in for a cheap volatility. If there happens to be a rally, then you're long puts and you got long futures against them. So I don't know. What do you think?
Yeah, I like that. I was just digging into some other products here while you were talking, trying to think of what should be next on our docket. I guess I could also go to our listeners. They picked number 2 here so far in the poll is crude, and number 3 is other. rates and FX and things. I may actually flip the script a little bit and get into the other, if you don't mind, Mr. Nick, because this is a week we had a lot of questions about what's going on in the rates complex. Obviously, the Fed doing their dance on Wednesday, doing their expected a quarter point raise effectively. So they've been making a lot of noise for the better part of 2 years now. We got to think about 3/4 of a point out of the whole thing. So it hasn't really been the big mover that we thought, but it was an active week. And again, we said Wednesday was a record day for the CME. A lot of that coming in the rates side. In fact, we had a question here. I'll just pump it up to the top of the show here. Allan German wants to know what happened in rates options this week with the Fed. Excuse me. Well, we can answer you here, Alan. I was looking at some of the products, some of your usual suspects, your 2 years and your 5 years weren't really lighting it up. It's the 10-year was where the action was outside of things like Eurodollars and stuff. So let's dive into the 10-year this week. That's where open interest was strong. We mentioned the record big numbers out here in the 10-year this week as well, about 15, nearly 16% in OI. So a big jump in OI this week for the 10 years. We said, the futures up about 1/4 point. So there you go. About what you expected out there from those. Vol also coming in as you'd expect, given, it's like any other product when you have that kind of event risk, kind of builds up into the event itself. And unless it's a very unforeseen event, and this was pretty much the definition of a foreseen event, then you're going to see vol coming off. That's pretty much what we saw. Vol coming off pretty strong across the whole term structure. Kind of peters out a little bit as you get a little bit farther out there, but still interesting stuff. Nonetheless, and looking at where the action was pretty active out here, like we mentioned, in the old rates. And number one with a bullet out here were the 127.5 calls. Again, this kind of gives you some feel for the kind of numbers we were talking about. We were just talking some big prints in the Emini S&P. We got some bigger prints out here, including 146,000 of these 127.5s. These are expiring pretty soon. These are expiring in about 7 days for these bad boys. And these things were lighting it up to, like I said, 126,000. Surprise, surprise. The big prints were on Wednesday with about 62,000, followed by Thursday, about 550,000. A lot of those were actually closing. So I saw people, not surprisingly, putting stuff on ahead of the number and then taking it off during and after the number. That's kind of to be expected in these kind of trades. Very similar numbers for the 126.5 calls as well, about 142,000 going on up there. Again, Wednesday leading the charge, 66,000, about half of that closing. So a lot of churn on these strikes. These are near kind of at the money strikes out here. So this is where a lot of the action was here this week, but still crazy big prints. Number three, the 127, again, expiring in about 7 days. These calls, 133,000, again, 53,000 coming up on Wednesday, and about 42,000 on Thursday. Again, a lot of that closing. So good churn, good back and forth trading on pretty much all of these strikes. Of course, if you go out a little bit, there was some action as well. And I say out, I use that, it seems like it's long term. It's actually only about a month or so for these AUG contracts here that are expiring again in about a little over a month. These were lighting it up too in terms of the 128 calls, lighting it up about 117,000 of these, including the lion's share, about 72,000 going up on Wednesday. Interesting about this is a lot of this is opening, so maybe we're seeing some rolls out here as well from those near-term contracts out a little bit farther. I use that term loosely, out to August, as we're seeing a lot of opening prints out here. Maybe we're to see some more aggressive upside trades, people looking to reestablish after the number for future aggressive upside here in the rates complex. Nick, we don't get a chance to talk rates a lot on the show. It isn't the most super happening spot outside of these Fed meetings, but it has been picking up of late. I know you come from the old rates world out there in the Eurodollars pit. So what are your thoughts here on what was lighting it up this week in the 10-year from a skew and from a volume perspective, as well as some of these big prints we saw going up here this week?
Yeah, well, first off, I think we should mention the fact that the CME's got a nice FedWatch tool out there, cmegroup.com/FedWatch, where you can go and take a look and see what the Fed funds futures are predicting in terms of a potential rate hike. So if you go out there now and take a look, you're going to see that there's pretty much no chance of any change going into the July meeting, which you would expect given that we just had a tightening. The other interesting thing just to mention, with all the talk around the Fed funds and the Fed watch, there's basically no open interest in the Fed fund options, which at one point early on when I was down there, and then even years after I had left, that was a pretty good product to trade. So what's interesting is to watch, and I know the Eurodollar has taken some of that away, but at the same time, you would think given the amount of just cyclical 6-week event volatility that's existing, there might be more interest in that, but that doesn't seem to be the case. Just talking a little bit around that 127 call in July, you'll remember, or if you take a look at the chart, you'll see that on the open, the July future or the September future rallied quite a bit. And I think early in the day on Wednesday, given that some of the economic numbers were sort of pointing to potentially having the ability to sway the Fed in terms of maybe not doing a tightening. So I think that's what you saw with that rally. You saw a lot of trade around the fact that maybe if by some chance they decided not to tighten, that we'd see the market move even higher. And I believe that's where a lot of the volume came from, because you saw, as you said, it hit a peak of 62,000 on Wednesday and even traded 50,000 on Thursday, and the market came off after that rally up over 127 on the open. So it was you even saw during the day where the Fed funds really went from almost 100% down back to 96%. That doesn't sound like a lot, but it's a 4% jump in the predicted probability that there would be a tightening. So there was some possible yammering about something not happening after all. But I think we can say with certainty that in all likelihood, it appears that nothing's going to happen in the next 6 weeks, but I think we're going to see ranges in these futures anyway, because we have been seeing ranges. We saw ranges in the Eurodollars. We saw some ranges here in the 10-year, and you're still seeing all the volumes occurring. Not the craziest volumes today, but even after the fact on Wednesday and yesterday, we had some pretty good volume. So it's fairly quiet today in terms of overall volume numbers. As far as anything interesting going on out there, I don't think there's much happening there. The one thing to mention is really to keep an eye on in the 10-year. They now added a Wednesday expiration, which corresponds with the Fed meeting. So this week we had an expiration that expired on that day after the meeting. So you had a really good opportunity to trade that. And why is that important? It's important leading up to the meeting, and it's also important the day of the meeting, because you really could trade like almost a binary expiring future with the premium on that Wednesday weekly. So I would say that you're going to see some activity in the maybe not Wednesday to Wednesday, but in these 6-week cycles between the Fed meetings. It's going to be interesting to watch how those volumes spike up and then flatten out in between. As far as anything with the Quickskew, if I look out here at the July, August, and the September, and I knew you were joking about out there on the curve, really the only contracts that trade in the treasuries in general are on the front futures contracts. So, there are listed for December and even March contracts, but there's really very little volume in those futures, and the options probably even less volume. So you won't really see those things start to come into play, or at least in December, until we get to the next roll period, which is a few months away. We're just out of the roll on the June contract. But 25 Delta strike, 25 Delta puts pretty flat today at the money. So that's if I look at this historically, let me take a look at this historically over our period of time here. Again, I think it's important to sort of you have the expirations that are out there right now, but it's important to sort of look at the 1 month, and that's typically how I look. I look at the 30-day one, and we're looking. Let's see. I want to look at the put ratio and see how that looks, and that's going to tell me how rich or cheap the puts are today at the money. And they're not the cheapest they've been, but they're around zero. And you don't see them hanging around zero all that much. They tend to be around zero, and then they spend a lot of time above zero and not a lot of time below zero. So I would think that if you get an opportunity to buy some downside puts cheap today at the money, probably a good idea in the treasuries, because you don't see it happen too often. And if I look at the calls and again see the rich or cheapness, these trade pretty flat today at the money, and right now they're a little bit above. So I'd say the puts seem in general a little bit less expensive than usual in the treasuries, and the calls seem about rightly priced. So as far as what's interesting, I think that's what's catching my eye right now based on the report. And again, you could go out there and look at the report yourself, cmegroup.com/TWIO or TWIFO. And when you go over to the Quickskew column, you're going to see two numbers. You're going to see a number, a dot, and then another number. And the left number is going to have a small p or a capital P, and the right number is going to have a small c or a capital C. And the small p means that it's a percent cheap to the at the money, and a capital P is going to mean percent rich, and over on the call side, same thing. Small c, percent cheap to the at the money, capital C, percent rich to the at the money. So go out there and take a look, and you might, if you're listening, you can go click on those top links, and you'll get the history for the Quickskew as well, so you can see what I'm seeing and talking about right now.
Thank you for that, Mr. Nick. Always good to have a rates guy chiming in on the rates. And last but not least on the product side this week, you guys want it, you get it. Of course, crude, our usual standby, our stalwart here on the old TWIFO program, getting bumped to the back this week, which is kind of interesting, showing some other stuff on the radar this week. But you guys want crude, we got to give you crude. And it was another week with the futures kind of selling off right around down to that 45 handle or so, about a point to a point and a half, depending on where you're looking out there on the term structure, a little bit farther out there, but still in the mid 40s range. All of you out there who are hoping for a bit of a resurgence, not getting that this week. Of course, the continued kind of lurking around this mid 40s region or so, and not really aggressively moving in one direction or the other, is kind of eating into the vol. That little bit of that burst, that juice of vol we got in there for a little while is coming off this week yet again, coming off pretty aggressively towards the front portion of the curve there, as we're seeing people are not wanting to buy any premium out there, at least not right now. They need another aggressive move. Could be the upside, sharp move to the upside, or maybe a more, doesn't have to be as aggressive, but a move to the downside as well would certainly inject some vol in there. I'll let Nick get into the Quickskew in a minute or so out there. But interesting week out there from a vol perspective. People have been looking to crude as perhaps a savior, a salvation source for a little bit of vol, as equity vol seems to be anemic right now, at least according to our poll, what you guys thought, and yet not so much this week. And in terms of number one with a bullet out here this week, we got to look to the AUGs. Let's look overall first. Another strong week for crude. About open interest up about 7%. So kind of getting back to that record over there at CME. It was a lot of products kind of chiming in on that one this week, crude being among them as well. Number one with the bullet, what was the hot strike, the hot action out here, the hot option in crude for this week? Well, it was those AUG 45, so that one not much of a surprise, probably really the front month kind of at the money, lighting it up this week. Total of about 26,001 to be precise. A good chunk of that opening, a little almost half. So good chunks of trade, including Thursday being the big day out there, about 15,000 and change. And then number two were the 42 puts, so that kind of nice tight strangle / risk reversal, call it what you will, 42, 45 being pretty active this week, about 23,000 of those, including about 10,000 on Wednesday. So a good chunk lighting it up there. Again, a lot of back and forth, a decent amount opening over there as well. Then we drop off a little bit as well to the number three, the 48 calls. So again, in that kind of front month, kind of near at the money, slightly out of the money range, about 20,000 and a half going up this week, including about 12,000 and change on Wednesday, that being the big day out there this week. And then, of course, you drop a little bit more. You get kind of a tie between the front month 39 puts, and going a little bit farther out, we've actually got these DEES 60 calls, both tying around 18,000 contracts. Actually, the DEES doing a little bit more, about almost 18,960 to be precise. Again, these are DEES 60 calls, so someone coming in with maybe a little bit of an axe to grind out here, including 10,000 lighting it up on Wednesday. A good chunk of that opening, too. About 5,000 or so of these contracts went up this week were opening. So a little bit of back and forth on this strike as well, which is kind of interesting. You wouldn't think DEES 60 be the strike du jour this week, yet it's pretty far up there, pretty active yet again this week. If you want another longer-term weird one, here's one for you. Far out there in DEES of 2019, someone trading 225 of the par calls today, the 100 calls. So if you think you're pretty aggressive on these, then you're not alone. Someone lighting it up to the tune of 225. So they got about a few years or so in the old bucket for those to pay off. Maybe a little bit of a fun flyer out there for them. They got a lot of headwinds against them right now, but who knows how that will materialize going forward. Interesting stuff, Nick. I don't think the size alone doesn't merit that really trumping those 2075 puts that expire in about 6 days in the S&P. That one's got to be the crazier of the two. But I like this guy's strike. He's swinging for the fences there on the strike, if not for the size. What are your thoughts? What caught your eye this week, Nick? From a Quickskew perspective, could be from a volume perspective. What was catching your eye out here this week?
Well, I still don't get what people are thinking when they go out there and buy those par calls that are way, way out there. I mean, because it can't be too cheap, given that there's so much time to expiration, but there's got to be a reason for it. And I would really, if anybody has any insight to that, that would be an interesting topic of conversation. As far as catching my eye, I think what really surprised me more than anything was, you and I have talked about over the last, months how the crude needs like a 2% and then another 2% move in order to really see the vol get kicked in. And on Wednesday, after the EIA report, the inventory report, where it was, I think it was obviously inventory a little higher than expected, that's when we saw the break. It was pretty much all the wind came out of the sales at around 10:40. I think it was Eastern or Central. It was around mid-morning on Wednesday. And what we saw was, we didn't see much reaction from the market. And I think what that means is that I think people know that we don't have much upside in us, and we're kind of at the bottom of our downside range, given, our open interest numbers and the support we have around the 45 strike, and even maybe a little bit lower now. I haven't looked at the OI yet today for the overall OI for the first year's worth of contracts, but nothing really happened. Vol came off, and it wasn't, this break wasn't exciting. Nobody cared, and they just continued to take vol, out of there today. So you see vol, if we take the 7-day contract, which is we'll look at the weekly, for instance. Another good sign here, and I mentioned it earlier in the show, the weekly that expires next Friday and the weekly that expires 2 Fridays from now, we had good solid open interest and volume this week. I mean, solid for what it has been. So that's a positive sign. It means there's going to be some short-term trade, and maybe we're going to see some of that liquidity move to those shorter dated options as we continue to roll forward here. But vol came out today quite a bit. We didn't really see much from a Quickskew standpoint. We still see the puts are bid and the calls are offered, but we don't see too much of a change in terms of the value, the percent rich or cheap for either one of those. So I guess looking at the way the market reacted today, looking at our price levels, we're at the 45 strike. We're trading just a little bit below 45 in the fronts and a little bit above. So we got a pretty flat term structure when it comes to the futures price here. When you're talking about, all the way out to December, and you have less than $1 in terms of the difference, there's not much volatility in that market. It doesn't look like there's going to be much volatility in that market, and it's going to be a tough trade. So maybe this is a nice segue into the question about the short strangle play that somebody asked about in your notes, because right now it doesn't look, we got a decent push up in the vol over the last couple of weeks, but it looks like all that's coming out, not much changing in the skew. And, I don't know. It's going to be interesting to watch because it doesn't look like there's very much exciting other than the fact that open interest and volume was good. Increased open interest, good activity in the weeklies, but not a lot of good volatility. So maybe they're just trading around a range of futures prices at this point.
You know what else is interesting, Nick, is what our crazy, crazy listeners have to say. No, I'm teasing. We love you guys. Crazy good. As we dive on into your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback, the portion of the show where you guys get to take the reins, questions, comments. Sometimes we ask you guys questions too. Nice little back and forth here. We did ask you guys today, like I mentioned, which futures options products are on your mind, maybe in your portfolio right now. Coming off S&P a little bit, was leading the charge about half. Now it's only about 40% for the Emini. A third crude coming up. A third of you gone crude and 27% going gold. FX rates or others. Interesting, Nick. No love for gold yet, which is kind of interesting. I thought for sure gold would at least get a couple of votes, but no love for gold. I got another. That's a short one. It's only about an hour or so. If you listen in after the fact, that poll's going to be closed. This is kind of a little flash poll we do during the show. We asked you guys a little bit longer term this time last week with volatility seemingly kind of going nowhere in the equities, at least in the indices. Where are you looking? Which new products are you hoping will give you some sources of volatility for your options trading? We asked you crude or metals or FX or maybe individual equities like your Teslas and others. And a lot of you looking to crude, about a third picking crude. So this wasn't your week, clearly, because crude did not deliver the vol you were hoping for. 27% coming in for the individual equities, your Teslas, your Amazon. The Amazon moving today, so interesting stuff going on there. And a tie for third, 20% each for metals and FX. Nick, you were alluding to this question. Let's get to this about from Marival. This one's been hanging in our notes for a while. We need to get this guy an answer. He says there's an interesting piece in the current Modern Trader. This was probably from a few months ago, so the link he sends over, so I don't think it's that current anymore. But still, the analysis is sound. He says, have you seen it? Oh, let me start that over. Interesting piece in the current Modern Trader about selling break-even strangles. Have you seen? What are your thoughts of this technique? Is it me, or are there new techniques for selling strangles all the time that always tend to blow out? Aren't you better off selling an iron condor or iron butterfly due to limited risk? He sends a link. I had a chance to quickly check it out. It's a long article. I didn't have a chance to read the whole thing. A lot of graphs and charts. We'll include it in the show notes, listeners. You guys check it out as well from our friends over there at formerly Futures Mag, now Modern Trader. And he was analyzing, I believe, these strangles in copper. And he's right. There are a lot of ways for people to sell, quote-unquote, break-even strangles. You could do, some sort of technical resistance. You see a lot of people doing it around low-hanging fruit like Bollinger Bands, which is, of course, one standard deviation above and below, your at the money there or your spot, whatever you're looking at, your resistance levels. And then you sell the strangles that way. You can do these a lot of ways. I do tend to lean the way Mr. Maribal or perhaps Mrs. is thinking here, and that I do see a lot of these coming out all the time. Here's the new way you should be selling strangles, and this is bulletproof. This is the best way to do it. No, this one is bulletproof. I'm with him that over the long term, you're going to give up a little bit of edge doing something like an iron condor or an iron butterfly. Is not even a strangle. That's really getting in there a bit. But I like a good iron butterfly, though, too. So I'm kind of more, even on both of these, though, you do have a defined risk for the most part because you have the wings to protect you. A lot of people don't want to do that. They don't want to go out and sell out of the money options and then buy further out of the money options to protect themselves. They're saying, well, I'm selling these things because they're overpriced. Why do I want to buy them? But, it does limit your risk. So if something crazy does happen, that tends to be the case. So I don't know, Nick, if you've had a chance to read this article a little more, I'd be curious your thoughts on this, if you have any, on this particular technique. But I think I'm more interested really, and maybe Maribal sounds like as well, on your thoughts on just these this continued plethora of ways to come in and sell premium, quote unquote, without blowing out. But reality, should you be hedging these instead? Where do you fall on that?
Yeah. Well, I thought the same thing, right? I looked at the article when it came out. I get that magazine, and it's a nice magazine, but sometimes the in-depth articles are a little too long for me to sit and, I want to be able to finish something in 10 or 12 minutes, and I think that those are requiring a little bit more than that. So if anybody's listening, maybe you can shorten them up a little bit or make them two-parters, right? So you have some more content for the following week. But, you make a good point there. I mean, I'm always looking and talking about the short strangle position from a standpoint of if you start to look at the open interest in a particular contract or set of contracts, you can idea where you might want to put that short strangle on, right? Because you're starting to either be on or below or above the short the resistance that you're going to get from the increased OI on any given strike. So, I think I still. The whole point of being short is to take in premium and to let that premium decay. Once you start buying options against that stuff, it's not quite the same return that you're going to expect. And I almost feel, and you said it yourself, I almost feel like it's just pay attention to it and then hedge it. And the hedging it becomes either, remember, you're short a strangle, right? You're going to get premium for one and you're going to get premium for the other, obviously. But as you move towards one short, you can start to think of that other strike as additional premium to what you are moving toward, right? So at that point, you sell something for 10, say it's 5 and 5, and then you're moving toward the put, and it becomes 7 and 2.5. But if you move far enough away from the call, you can almost say, oh, that call is not going to come back into play. So you can start treating it like a high premium put, and then you can hedge it. And if you feel like you're going to go through that strike or you're at risk, or you can start to look at something a little bit cheaper that's outside of that. So you don't necessarily turn it into a spread as opposed to just an outright, and then pay attention to the other open strike, so you don't get caught on the reversal of the underlying. So I still like the net short strangle as the play. I mean, I get the iron condor and iron butterfly. I understand that because you're naturally turning them. You're basically doing two spreads, with the higher premiums being short, but why not start with the short premium and then hedge those accordingly based on which way the market's going? Give yourself a little bit bigger chance to get some decay out of that until it doesn't work, right? That's what I think.
Yeah, this is kind of one of those to each their own, pick your poison. Some people who are the hardcore premium sellers, they don't want to buy those wings. Others who get concerned, they see the historical analysis that most of these strategies will, over a long enough time frame, probably end up blowing out in some way, shape, or form, or at least having significant drawdowns. If you want to avoid those, maybe you give up a little bit of your returns to do that. There's both ways. I tend to lean, at least for recommendation purposes for people, really a lot of these. I do like an iron butterfly, but it depends on the underlying. It's got to be really suited for it. And if you're going to do that, you got to really be on top of it. You can't just set it and forget it. That's not that type of trade. That's really, you got to get in there and make sure you're maximizing the decay, hedging, that sort of thing. Iron condors are sometimes preferable with people because of that, because they're a little bit easier. They're not quite set it and forget it, but you kind of can. A little bit more than a butterfly, obviously, because you're not quite at the money. You're a little bit outside. You're selling that strangle, buying another one. So it's a little bit more risk averse if you want to leave that way. Good stuff. I like the long form. I think there's a place for long form articles, Nick. Maybe Modern Traders got it. Sometimes people want to get in depth in that. It's more of a publication. They got a room for that kind of stuff. So I'm cool with them. If they want to run the long form, go for it. Check out the article if you're interested. This has a whole breakdown on what exactly the methodology is. We didn't really have time to get into that because that's a long conversation, but the general question I think is more interesting anyway, at least for us. All right, let's see. We got time for probably a couple more. We answered Mr. Allen with the rates already. Here's a good one for you, Mr. Nick. This comes from Tim Vickers. He wants to know, we talk about Quickskew a lot on the show. He says, do you put out a Quickskew report or anything like that? I don't want to put words in your mouth, Nick, but I think you guys are working on something like that. Am I correct?
Yeah, it's funny. I'll actually tweet that now and make sure it gets out there either just before the show's over or just after the show's over. Yeah, we have a Quickskew report, and it's meant to really look at the 30-day contract. So it gives you a nice sort of measure across about a year's worth of time. So it'll show you some current numbers and then compare those to 1 month, 2 month, 3 month, 6 month, and 12-month Quickskew timeframes. So I'll put that out there. So there are a variety of different Quickskew reports. There's sort of the general benchmark Quickskew report, and then there's also a specific Quickskew report. So what I'll do is I'll tweet 2 or 3 links out. One will be the generic general one that'll show the whole benchmark, and then I'll put one out there that's specific to a particular product. And yes, Mark, I think we're gradually starting to release Quickskew information to the paid subscriptions. Before, we didn't have it anywhere except on the show and what I tweeted, but I think we're going to start putting it out there and letting people see at least a partial history of it, and then hopefully pique people's interest enough to want to at least take a look and see what it looks like inside the subscription. But I will continue to put out charts and snaps of the overall report as well.
All right, we got to sneak it in here. People keep hitting us up with this. I guess we're the go-to Bitcoin show on the network here now, Nick, because we got to sneak one in here at the end. This comes from LennyK. This says, dude, Bitcoin, how nice it would have been to have a put this week. Yeah, that's kind of gets to what we were saying last week when you guys are asking us about Bitcoin. It wasn't shall we say, the best week for the old Bitcoin. I think at one point this week, if you the Thursday lows, I haven't pulled up the latest numbers for today. They were off about 19% for the week, which is not a good week. Again, this kind of gets back to what we were saying before. It's kind of a bit of a free-for-all out there, kind of a Wild West, because there aren't really a lot of sanctioned, regulated, certainly listed type entities, exchanges really that are trading these things that have that have listed clearing behind them and all the other things to do to really kind of mitigate some of these extreme swings. If you have a real market with market makers backstopping these things, you tend not to see. I mean, you still see movement, obviously, as we see all the products talked about today, but perhaps not as extreme as these types of things, because there are people in there playing with it and hedging and doing things like that. So that said, we don't have those listed. So yeah, this would have been a nice week to have ourselves some puts. I'm looking at the chart that someone sent in from last week. 35 bear market since 2010 for Bitcoin. The sharpest falls were nearly about 70% from April, about a week in April. So this doesn't rank up by there, I don't think, but unless there was the sharp sell was more than I thought. We see about the lowest on this top 10 was about November to January of 2014. So that's about a 2-month period where it sold off about 58% or so. So a bad week, not perhaps the worst week in the history of Bitcoin. It's obviously seen a lot worse. Any asset that loses 70% of its value over the course of a week is shall we say, volatile. But yeah, this kind of just strengthens the argument, I think, Nick, and people are asking about it. People clearly got this on the brain. But I think this just strengthens the argument to have some sort of listed, actual product that people can actually trade. I mean, there are products out there. There's all these new Ethereum's, kind of the new wrinkle on it and everything else like that. But nothing that really holds up to the scrutiny I think you and I, most people who trade the listed type products, really expect. I don't know. What are your thoughts here, Nick? The ongoing saga that is Bitcoin, and it probably would have been nice to have a put or two in your back pocket this week, don't you think?
Well, I mean, it's always good to have a put if the market goes down, no matter what market it is. So, and I would imagine that Bitcoin, given the rally that we've seen over the last 6 months, that skew would look just like the index skew has looked for the last however many years, right? You would see basically like a slice from the top left to the bottom right where the puts would be bid because people would be hedging their profits. So yeah, it'd be great to have a put, but a lot of times, depending on how much that put broke and how high of a volatility you paid to get in at that strike, you may not get back as much as you think you would get back, right? Just the same old story that we hear all the time, right? It's not necessarily that you bought a put, but it's at the level you bought the put as well. So yeah, it would be great. Might have been, what would have been better, Mark, than a put? Would be short Bitcoin, right, in a falling market, right, as opposed to just
yeah, that's true.
So
that might have been a rough trade throughout most of the year, but you would have been taking some tums throughout most of the year to get your 1 week back.
Right. But yeah, put's great in that kind of market, of course. But I feel like it may, depending on how high the volatility would be, it would be interesting to see what kind of money that made.
Yeah, I'd love to see a market maker opening markets on, let's say, a 5% out of the money puts on a Bitcoin if they're ever listed, because that would be pretty juicy, shall we say, especially given this week's activity. Mr. Nick, that music means we've come to the end of yet another epic sojourn. What an epic one it was this week. We covered a lot of ground this week. Started off in E-minis. Don't get to play in E-minis that often, so it's kind of fun to get in there, see what's cooking, seeing what's really underlying maybe some of these things you guys are asking us about the skew, as well as, of course, surprise puts out there. 2075, we'll keep an eye on those. We'll talk about those next week, Nick, see if those hit out or not. I'm going to guess out on a limb the answer is probably going to be no. Otherwise, we'll be talking about a lot of other things, including the aggressive return of volatility if those puts come into play next week. Also touched on some crude. What was the action out there? The rates, what did the Fed do to the rates? Well, we talked about that a wee bit as well as, of course, your old favorite, Bitcoin. Can't get enough of that. Quickskew reports, all sorts of fun stuff. Remember, if you want to follow along while you're listening to the show, whenever you listen to it, head on over to cmegroup.com/Twifo. Those reports are always running. They're always good. It's just that sometimes only the links are only clickable to see more detail. And when you see the top strike for answer, the most active, you can't click on those except when the show is live. So if you're not a subscriber, that's your back end way to do it. But you can listen to the show and watch the reports pretty much anytime. Remember, if you go in and you're listening to it in the middle of the week or something like that, just tweak that expirations tab so you can get the actual report Nick and I are looking at, which is this week, kind of week to open, week to close kind of thing. That said, Mr. Nick, you guys are always cooking up cool stuff. what else is on the docket aside from these forthcoming Quickskew reports from you guys over there at Quickstrike?
Let's see. I got a new build going out this week, so we'll have some updated functionality in the CMEgroup.com Treasury Analytics report that we provide. Also, if you're not aware, and this is more for OTC institutional, is the vol quoted options over at the CME Group started. Well, all six of the big currency pairs will start trading. We'll start trading this week. So there's a new tool out there that'll be available if you want to actually watch and see options quoted in vol terms. They'll have a bid ask for the vol spread, and that'll be something, and you'll be able to see the premium and the delta associated with those as well. But sort of a different way to look at options themselves, right? We always think of premium and then apply the volatility from that, but this one you get the volatility, and it's just more of a agnostic way to take a look and see what level something's trading. And then as far as that goes, enhancements continue to come down the pike, and as anything interesting gets out there, I'll make sure you guys know about it. But right now, we'll take a look and see if you want to learn more about the treasuries, go out there and look at that new Treasury Analytics tool.
There you go. Thank you for that, Mr. Nick. Cool stuff about the volatility execution. You get asked that question more than you'd think. Hey, can I look at or see options executions and trades in pure volatility terms? That's a hard thing to do, but it sounds like you guys have cracked that nut, so check it out with our friends over there at Quickstrike. On behalf of Nick and his team, and of course our friends over there at CME, and indeed yourselves, I want to thank you guys too for downloading, streaming, and subscribing, and all the other fun stuff you do, sending in such great questions and topics, and all your Bitcoin love. Keep that coming too. Why not? It's fun. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quickstrike, options pricing and analysis software. Quickstrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quickstrike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quickstrike is the perfect addition to your trading toolkit. Learn more about Quickstrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at Quickstrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.